April 2022. Let's go around the room and make our introductions for the record.
Stephanie Zimberg, representing Commissioner Stilwell.
Allison Hirsch, representing Controller Brad Lander.
John Dorsa, alternate for Controller Brad Lander.
Rob Appling with Wilshire by invitation of the trustees.
Joe Alejandro, PBA.
Thomas Gilmore, PBA.
Chris McGrath, PBA by invitation.
Nicole Giambrisi, Police Pension Fund, present by invitation.
Anthony Bradley, SBA. Jeffrey Ward, DEA.
Tony Ramirez, DEA.
Bob Stansky, Pension Fund, present by invitation.
Okay.
Stanley Thomas, Pension Fund, present by invitation.
Andy Vincent Miller, Police Pension Fund, present by invitation.
Kevin Holleran, Pension Fund, present by invitation. And I know Lou Turco is here. Mayor's office.
He is Lou now.
There's Grace.
Bill Dukes for Mayor Adams.
Okay, Finance.
Jim Monray for Finance Commissioner, Preston Nymbach.
Okay, with that, John, I'm going to turn it over to you.
Okay, so thank you, Kevin. So I just want to acknowledge for the record that there are several members of the BAM staff that are on who we will ask to identify themselves as they present today or as they give comments. I also want to note that we're joined also by other members of the Department of Finance, as I can see, as well as other consultants that are joining us remotely, and as well as the actuary's office. And we will ask those folks to identify themselves as they participate in today's meeting. So with that, I'd like to start off by introducing Mike Haddad, the interim Chief Investment Officer. I want to note Mike wishes he could be with us today, but unfortunately is a little under the weather. So we're going to ask him to do his quarterly report to the best of his ability today. But if he needs to cut it short because he's a little hoarse, we're happy to understand that and move accordingly. So with that, Mike, I'll turn it over to you.
Thanks, John. Mike Haddad from the Controller's Office, here by invitation. Appreciate that invitation, but if I have to exit, John, it's not because I'm hoarse, it's because I need to run to the men's room. So.
Sorry, Mike, you're a little bit coming in and out.
Okay, is this better? A little closer?
Much better.
Okay, let's just jump right in. Kate, can you share the screen, please? Next slide, please. So we're excited to unveil our new quarterly performance reporting to you all. Some key changes in how we're doing it this time. And I would say the key change is we're going to have deep dives by 2 different asset classes every quarter. This quarter, we're going to have public equities, John Merceburg reporting, and an infrastructure, Petra Nikolova. And so instead of hearing more from the CIO from a high level view, we're going to dig deep into 2 of your asset classes per quarter, and we're going to rotate it by quarter. So just to set this table here for the structure, kind of think about in 4 parts. The first part, I'm going to do market overview and performance reporting for your portfolio as of Q4. Dan Haas is going to hop in with some risk analytics about the quarter. Then the second part, we're going to shift into some more forward-looking concerns. And then from there, we're going to go to, with some stress tests along those concerns. Then we're going to go to executive session and give you a more timely look at your portfolio, and then the deep dives, as I mentioned earlier. So with that being said, let's jump in. So here are public market returns for the fourth quarter. I know it seems like ancient history, but nonetheless, here it is. A couple takeaways from here. The very strong quarter, both outright and absolute by U.S. equities, up almost 9.3% in the quarter.
The screen was, the way you had the gallery, the last column on the chart would be. Wait, 1 second.
Sorry, I'm hearing some feedback. Someone needs to mute.
Sorry, is this better? That's better. Thank you.
And then I would also point out in emerging market equities, the negative return. And I'm going to talk about that on the next slide. And then in all of your interest rate products, note the positive returns in long duration fixed income. But if you go down the slide a little bit, those bottom 2 rows, investment grade and high yield, the returns are barely positive, as yields in the front end were actually up in the quarter, but yields in the back end were down. We call that a yield curve flattening in fixed income terms. Next slide, please. So how do we explain this quarter? A few different things. The Omicron variant was front and center in the fourth quarter. As a reminder, it really hit in the United States in early December, but prior to that, it had started in South Africa, Denmark, and England. And the scientists were pretty accurate with their predictions that it would spread dramatically, but that its virulence would be low. Nonetheless, it did slow the service sector reopening, which helped keep long maturity yields low globally. The second big change was the increase in inflation. That started in really in earnest in the fourth quarter. And if you recall back then, the market consensus was it was transitory, that it was supply chain driven, it would work its way out. And as we know today, that story has dramatically changed. And because of that, the curve flattened. So 2-year notes were up 35 basis points, while 30-year yields were actually down 15 basis points. To get movements in the opposite direction of the yield curve is highly unusual. And then the last part, the emerging market underperformance, a couple factors driving that. The emerging market central bank rate hike started in earnest well before developed market central banks, and I listed a handful of them here. Then the other big theme was China's pivot to what they call shared prosperity. As a reminder, this started with the private market education stocks all getting hit really hard in the Chinese equity market, and then spilled over into some of their mega cap technology stocks as well. Next slide, please. So your portfolio, and because we're able to do this directly with just you, we don't have to do any comparisons between you and the others, so we can just focus on your portfolio. So here are all your asset classes. The second column showing the market value at the end of Q4, and then that bottom line shows the size of your total portfolio at the end of Q4 of $53.5 billion. So let's start about 2/3 of the way down for your total return for the 3 months ending the fourth quarter, 4.08%, and the 1 year 14.11. Both good numbers, absolute and relative. Relative, the bottom 3 rows in this chart show the 3 benchmarks that we like to talk about. So the middle benchmark is your custom policy benchmark, and you'll see both on the 3-month and the 1 year that you have slightly outperformed. That's a good thing. When we compare you to the public and market equivalent of a 65 equity, 35 fixed income, you can see a small underperformance in the 3-month, but an outperformance in the 1 year. And the 3-month underperformance really has to do with the composition of that benchmark, and that it does not include any emerging market equities. And as a reminder, we talked about emerging market equities being down in the fourth quarter. The last benchmark is the median fund TUX. As a reminder, TUX is I can't remember what it stands for, but it's endowments, pensions, and other pools of capital of 20 billion and larger. So it's somewhat similar, but not the same. A reminder, it's reported gross of fees, not net of fees. Everything that we're going to share with you is net of fees. Secondly, they have greater exposure to private markets, which, as you can see above, really contributed to your strong returns in the 3-month and 1 year. So back up to the returns here. I really want to draw your attention to both the 3-month and 1 year returns in private markets. You can see the very strong returns in real estate, in private equity, and in infrastructure. And we're going to we're going to go a little bit more into that in the next few slides. Next slide, please. So when we decompose your returns versus your benchmark, 19 basis points of excess return broken down into 2 subcomponents, the asset allocation impact and manager impact. Asset allocation was -3, not worth spending time on, but what's more important is the alpha delivered by your managers, and that's what we really want to focus on this morning. Next slide, please. So here, so we break this down into public markets. The next slide is private markets. Another change that we've incorporated is on public markets, we're showing you 3-month as the shortest time frame. In private markets, we're doing just 1 year because not a lot changes in private markets quarter to quarter. And we thought it was more important to focus on the 1 year and longer time frames. But in public markets, which are marked daily, there's a lot more content there. So excess returns by your managers. In domestic equity, very little, as you would expect, given that the vast majority of your market of your portfolio is indexed. In EFI ex-USA and emerging markets, there's some deviation there. John is going to go into detail on the attribution for that. The only other line to draw your attention to is converts, a lot of noise there, and that has to do with the composition of the benchmark versus the guidelines around your managers. Specifically, the guidelines around your managers call for investment grade only investments, while the benchmark has non-investment grade, which is a lot of these tech stocks, which despite their extraordinarily high market valuations are not investment grade from a debt perspective. Next slide, please. So this is where it gets more interesting. Again, 1 year returns, a handful of different time frames, including since inception. I'm going to leave infrastructure to Pecha later. I'm just going to go through a handful of these. Just bear with me. Hedge funds, small outright return, if you recall from a previous slide, and small negative return relative to your benchmark. Not a whole lot to talk about here. Some underperformers were Caledonia, and as a reminder, they're very much in that growth portion of the equity market, and that has suffered over the past quarter. Positive returns came from D.E. Shaw and your alternative market trend following systems. So think Florin Court and the other one escapes me at the moment, SRS. In private equity, the returns are absolutely stellar. So the 1 year excess return of 17.6%, and this is over a benchmark that returned almost 31%. So as a reminder, the benchmark is the S&P, the Russell 3000. So the fact that your funds return that much more just speaks volumes. Over 70% of your funds outperform the benchmark, with the key performers being Apex, KKR, and EQT, which all on a 1 year basis return greater than 70%. Other star performers were Platinum and Warburg Pincus in excess of 50%. And when you think about the attribution of those returns, it was both realizations and also increases in the marks of their portfolio companies. So how that pans out in the future, obviously important, but it wasn't just market up, there were realizations as well. In real estate, very strong performance here as well. And this had both to do with the portfolio construction of your portfolio as well as the managers. And by portfolio construction, what I'm referring to is you had managers in the sectors that were not impacted so much by the pandemic. You avoided hospitality and leisure and had more in industrial and multifamily. The strong performers here included the various Exeter industrial funds, Prologis, and then some of the big names also did well too, including Blackstone, KKR, Airmont, all in excess of 25%. And OFI, again, very strong performance. And it was really driven by three of the larger allocations, which had a more flexible mandate. So they were able to respond to some of the changes in the markets and really provide what they would call capital market solutions to some of these companies who are struggling with the pandemic. And the strong performers here were Marathon, Apollo, Oak Hill, and KKR. And those four managers accounted for about 50% of your total return in your OFI portfolio. Next slide, please. So in terms of rebalancing activity in the fourth quarter, I just want to remind you again of that first slide when I showed you the very strong return in U.S. equities. So as U.S. equities continued to rally, we had been maintaining a slight underweight to fixed income and a slight overweight to public equities. And this took place as the markets rallied. So we tried to hold your overweight 2.5%. And if you recall last quarter, we had rebalancing, reduce some of your equities in order to keep it around 2%. Well, in the fourth quarter, as inflation started picking up, our concerns about the Fed having to raise rates and slow the economy were heightened, and we did not think appropriate to run any kind of overweight at the time. So we were active in reducing your U.S. equity overweight. You can see that in the first part of this slide. So we sold on your behalf roughly $1 billion worth of equities in the fourth quarter. Where did that money go? A little bit to your underweights and fixed income, but most of it went to the cash desk. Next slide, please. Another slight change is how we're reporting your underweights and overweights. Instead of showing you the bubble charts, which I think had good content, but it was hard to really delineate into the various asset classes, we decided to put it in a table and just show you how these, and again, emphasis on very slight underweights and overweights on a time series. So the end of the second quarter, end of the third quarter, end of the fourth quarter. And as I had mentioned in fixed income, we had been running slight underweights as we thought yields were very low given the fundamentals, and slight overweights into your three sleeves of equities. And as you can see in June and September, the sum of those three lines were a little over 2%. But by the time the quarter ended, it was just slightly positive at 0.7. So that's what I was talking about, that rebalancing. We took you from something like 2% overweight closer to neutral. Next slide, please. Yeah, and then I'm going to turn it over to Dan, who's going to walk through some of the risk analytics with Q4.
Great. Thanks, Mike, and good morning, everyone. Today, we'll just review, as we have in the past, just highlights from the quarterly risk summary that appears in the reports and convene. If we look at the top left panel, you'll note that the total planned risk for the quarter ended on December 31st was 11.25%, down from 12.1% in September. Benchmark risk is 10.38% in December, declining from 10.93% a quarter ago. The portfolio risk declined a little bit more than the benchmark risk, and we see small corresponding reductions in the active risk and beta from last quarter. If we move to the bottom panel, we plotted the ex-ante portfolio risk, the blue line there, the benchmark risk in the red line, and the beta, which were the gray bars, for each of the last 12 months ending in December. Notice here that the projected portfolio and benchmark risk continue their downward trends as we've observed in quarters past. The chart at the top right breaks down the change in risk during the fourth quarter into three broad categories. There's the change in volatility, change in correlations, and the change in portfolio exposures. The change in volatility and the change in correlations categories are market-driven phenomena, meaning that the risks declined in step with market risks and were not the result of specific position weights or tilts in your portfolio. The change in portfolio exposures represents a portion of the portfolio risk that was detached from those market trends. Here, you see the 36 basis point reduction in risk was led by U.S. high yield spread factors and some country factors, most notably the U.S. and Eurozone. Finally, the table at the top center shows you the differences between your portfolio allocation by assets and your allocation to risk. As in quarters past, you'll note that we've allocated about 2/3 of our assets, 66.2% in this case, to equities. The standalone risk coming from the equity portion of the portfolio is 15.76%. Standalone risk coming from fixed income investments is 3.8%. And then if we move over, looking at a contributory basis, we see that 10.39% or 92% of the total risk in the portfolio is being driven by the equities. And we'll elaborate that theme a little bit on the next slide. If you don't mind moving the slide ahead, Al? Perfect, thanks. Here we're summarizing the portfolio allocations, performance and risks by strategy as of December 31st, 2021. If we look at the leftmost section, you see a snapshot of your parking place adjusted allocations on December 31st. At that time, we had slight overweights to cash and we're underweight our core fixed income strategies. Again, just kind of echoing Mike's slide of a few minutes ago. The performance section in the center gives you a 1-year return by strategy relative to their benchmarks. Here we see the alternatives outperforming their benchmarks, and then we see an underperforming developed markets equity, which John Merseburg will be elaborating on a little bit later. Next, we are decomposing the risk by strategy in that last section there. The first three columns in this section show you the portfolio risk, the benchmark risk, and the active risk or tracking error for each strategy. Tracking error is an indication of how closely the portfolio follows the index to which it's benchmarked. For context, you can expect almost no tracking error, for instance, coming from a pure passive portfolio and its benchmark. You'd see perhaps 1 or 2% of tracking error coming from an enhanced index fund. And then you expect to see something about, above 4% for actively managed funds. Along those lines, you note that tracking error is comparatively low for U.S. equities, where there's mostly passive equity strategies, and a little bit higher for emerging markets where we're invested with active managers. And then lastly, we show you how the individual strategies contribute to the overall risk in that rightmost column. That's pretty much all we needed to cover in this section today. Happy to take any questions you may have, and I can do that either now or offline at your convenience.
Any questions?
Well, I do have, just to go back, not on that chart. So Mike, are you still on?
Yep, still here, Joe.
Okay, I just want to make sure, is this the total presentation? I guess you're done, or you're going to go through world events?
World events, and then in executive session, a more timely look at your performance and any overweights and underweights.
Okay, I just quick explanation then. I just want to make sure that, because every once in a while I have to remind myself also of various issues on the portfolio. With regards to, let me go to chart number 8, page 8, private markets, excess net performance. All right, last year at the time, the market was doing pretty well, right?
Yep.
This time, okay. So with regards to hedge funds, my understanding is the idea of hedge funds is to be non-correlated to markets, correct? To use certain techniques that they utilize and not to go up, they're not to buy the market. That's what happened in 08, where a lot of hedge fund managers were going long on the market and they were losing as the market went down, right? Would that be correct?
Yeah, particularly the long short, long short equity managers.
So in certain, even though high market return environments, you may see these types of events with, for example, hedge funds, because their techniques are geared towards more non-correlated returns, correct?
Yes.
Okay, I just want to make sure that we're clear on that, it's not a quirk of just hedge funds always underperforming the market. It's just that they were hired to do certain things. They're doing it. And of course, they get locked into those things. And if the market goes up extraordinarily, their returns are not going to go up necessarily with that. Okay.
100% agreed.
Okay. I just want to make sure we're clear on that. Yeah. And as far as let me see, on the convertibles, you were saying a lot of noise. My understanding is with converts, they're bonds, but they could act like equity later on. They're converted. So in a high inflationary environment, converts are, in my understanding, again, I could be wrong, so you have to explain it to me, are a pretty good tool in order to take advantage or just stay as a bond in high interest environments. Can you explain that to me just quickly?
Yeah, so think about converts as a bond with a lower coupon than typical bonds of the same credit quality, but you get an equity warrant or a call on the underlying equity of that, struck 20 to 30% out of the money. So
do you have to convert, or you could just hold it for a period of time until such time that the warrant mandates you have to convert?
Yeah, exactly. You would only convert it if the strike price on the warrant is higher than the strike price of the stock. But in the meantime, you're earning, a 2 or 3% coupon, which gives you a little more stability in your returns rather than just pure equity.
Now, in a high interest type of environment, just explain, would you want to convert? Would you just want to hold for a while?
It all depends upon what that equity price does. The rising rate inflationary environment is not good for your coupon because it's fixed, it's not variable. So you're locked into a lower yield than if it's a reset quarterly like some other asset classes allow. So
Would it be based on the fact that if you have let's say a convert in a particular investment area, for example, let's say oil, I'm just making it up, you would want to convert to take advantage of the high price of oil, right?
Yes, absolutely.
Right. You wouldn't want to hold on to the coupon. Same thing with anything that might not do well in a high inflationary environment. You'd want to hold on to the coupon rather than just convert.
Right. And don't forget the price of the convertible. It's a security, with a QSIP and all that. So it trades in line with the fundamentals that you brought up. So in the energy one, if that convertible was issued at $10 and it's, $20 in the money, that thing's going to have doubled or tripled in price for you.
Right. I just wanted to go through that real quick because I have to remind myself of these things too.
Yep.
So,
Kate, can we go back to slide 5, please? I want to address the hedge fund as well. So I would encourage you to look at hedge funds not on relative performance because the benchmark has a much higher weighting to long short equity than your portfolio. And as you articulated, Joe, your portfolio is designed to make you money in all environments. And in a strong equity bull market, it's going to underperform its benchmark. But in a negative equity environment, we expect stronger returns, both absolute to the equity market and outright. So with that being said, if you look at the longer time frames, the 3-month number was definitely disappointing, but the longer time frames are all still right within how we've designed it. And I don't want to jump the gun on Q1 of 22, but I think you're going to be pleased with the numbers that we report. That your
expect with the volatility, that's where the managers do well in high volatile environments.
And then not only that, but you think about the trending markets and commodities, the grains, the energy, and you have exposure to a handful of managers who are in trend following systems. And my expectation is that was a very rich environment for them to perform for you.
Okay. All right, Mike, thank you.
Sure. Kate, can we go to forward-looking concerns, please?
Global macro.
Great. So a lot has changed from the fourth quarter in terms of the world and what we're focused on today in the markets. The two things I want to talk about today are the Federal Reserve and global central bank rates, and then the market implications of Russia's invasion of Ukraine. Let's start with the Fed first. Next slide, please. So what this slide shows, these 6 orange dots are the starting point of previous Fed tightening cycles. And what this graph attempts to show on the vertical axis is the deviation away from the inflation target, and on the horizontal axis, the deviation away from the employment target. And what you can see here, again, compared to other cycles, the inflation miss is very high. The employment, this chart's maybe a couple months old, but the employment target shows less than full employment. And what we've learned since then, we got the employment report last Friday. The rate fell to 3.6. And importantly, something else that Fed Chair Powell highlighted in a speech a week ago. Apologies, the dog going out for his walk. Just give me 1 second. Sorry. Sorry about that. What Fed Chair Powell highlighted in a speech a week ago Monday was it's not just the unemployment rate they're looking at, but they're looking at the jobs, number of jobs openings there are relative to the number of people unemployed. And it's a striking number that has led the Fed to believe we are at or past full employment. That's reinforced by wage growth. And the point of this slide is to show how far behind the Fed is and how inappropriate their policy is and why so much tightening has been built into the market in such a short period of time. Next slide, please. So the number of rate hikes priced in over the calendar year has really accelerated in 2022, and that's a function of both the data and Fed policy and Fed rhetoric. And not only so this shows number of 25 basis point rate hikes. But over the past week ago, again, referencing that speech by Powell, the market has almost fully priced the front end of the bond market, 50 basis points at the May meeting and 50 basis points at the June meeting. So there's been a massive change in the trajectory and the pace of the number of rate hikes that are coming. Next slide, please. And again, when we talk about rate hikes, it's important to have some perspective as to how high the funds rate has to go to achieve the Fed's objectives. And again, that number's moved up quickly over the past week or so to almost 240. That's a little bit higher with the market action today and late last week. It's closer to 250. And important for markets to ascertain is a funds rate of 250 enough to slow growth and to get inflation back down somewhere near its target. And to put that in perspective, in previous rate cycles, the terms you'll read in the press or hear fixed income people talk about, the Fed has to get to neutral or the Fed has to get into restrictive policy. And you can think about that relative to its absolute level, but also relative to the inflation rate. And what the market is anticipating and pricing now is it's not going to take as many hikes as one would think, given, CPI last month was 7.9%. And if you have to get positive real rates, if you have to get the funds rate over 8%, the market is not priced for that, and that would be very difficult. What is the market anticipating in inflation? It's anticipating the peak this month. Unfortunately, up. I think expectations for headline CPI are about 1.2%, which is going to get us close to double-digit inflation. But then a slow and gradual decline. But from things that I've read and folks I've talked to, it looks like 2022 is going to end somewhere 6%-ish. And in 23, as the supply chains get ironed out, then the market anticipates that to come back down. So in my humble opinion, the bond market is priced for a soft landing in that inflation comes down. Combination of the Fed rate hikes will get the inflation back under control. But to me, all the risks are that it's going to take more than what's priced into the market now. Next slide, please. As we learned during the global financial crisis and during the pandemic, the Fed has multiple tools at its disposal. And it was quantitative easing when the markets were in periods of stress, and when markets leave periods of stress, we go into quantitative tightening. So what is quantitative tightening? That is when the bonds that the central bank owns, when they mature, they no longer reinvest those proceeds back into the market. Instead, they just let the maturities take place, and thus reducing the size of their balance sheet and reducing the amount of demand for fixed income instruments. So all things being equal, and you can see the spike that we had in the pandemic, both outright, and you compare that to the global financial crisis, and then the whole European debt crisis, which was 12 and 13, and you can see the magnitude of the quantitative easing was huge, and that needs to be slowly unwound. So we expect the central bank, the Fed, to start this in May. And the key components of that are going to be at what pace they do that and how much they want to run off. And as a reminder, if you look the period between 2018 and 2019, that's the last time the Fed was engaged in quantitative tightening. The 10-year note got, I think, over 3% during that time period. And importantly, the U.S. equity market fell 15% in the fourth quarter before the Fed reversed and started easing again. So this is a cautionary tale for risk markets going forward if the Fed has to do more than what's priced in now. Next slide, please. So how do rate cycles impact the U.S. equity market? One of the important equity valuations is the forward price earnings ratio, and that's what this graph on this slide shows. And you can see on the far right of this, the forward PE ratio has come down from in excess of 22 down to closer to 19, and that's with rising interest rates. One would expect forward PEs to come down. So the fact that it has receded takes a little bit of the froth out of the equity market. But when we step back and look at longer timeframes and in history, even with this contraction in forward PE, the only time we were higher was before and after the NASDAQ bubble, the earlier part of the century. So to me, this is still a source of concern, although it has lessened. Next slide, please. So more on forward PEs. What this graph shows is the forward S&P price earnings ratio against that dotted blue line, which is the 10-year real yield. And that's the 10-year real yield is inverted on the right scale. The lower that line goes, the more positive real yields go. And what most market participants think is in this rate cycle, real rates have to get positive, if not up to somewhere between 0.5% or so. And if you follow that relationship, that would mean a further compression in a forward PE ratio of around 16. So again, a source of concern if this relationship is to hold. Next slide, please. So now the next few slides are meant to be less alarming and more not alarming at all. So this breaks up again forward PEs of the top 25 stocks and then the rest of the S&P 500. And what you take away here is that the elevated PE ratio of the market is really influenced by those top 25 stocks. And these are really high quality stocks whose earnings are absolutely fabulous. Think Microsoft, think Apple, think the Google complex, and then even some of the JP Morgan, Berkshire Hathaway. The blue line is the rest of the S&P 500, and that trades at a more moderate PE ratio. So this slide is supposed to give us some sense of calm with regard to forward PEs. Next slide, please. Again, more relief. This slide breaks down the equity market into several different sleeves. On the far left, the S&P 500, on the far right, the NASDAQ composite, and then different sleeves in between. The commonality you see in all of these is that the index has outperformed both the median stock as well as the average stock price decline. So again, the takeaway from this is that while the indices are still high, it's being supported by a handful of very high quality, high market cap stocks, in that the carnage underneath the index is significantly greater than the index itself. And you look at the NASDAQ composite, the average stock is down 45% from its high, while the index is only down around 20%. So again, a lot of decline has already taken place. Next slide, please. And then the other source of calm is that a lot of the speculative excesses in the markets have been absolutely taken to the woodshed, if you will. So this shows a handful of different of the speculative indexes and their retreats, which are all in excess of 40%. So this graph shows the IPO index, the SPAC index, the renewable and clean tech index, and then a fintechs index as well. What's not included on here, but would fit into the same category, would be the whole crypto complex. As a reminder, it peaked over 3 trillion in market cap, and now it's I think slightly under 2 trillion now. Next slide, please. So as to Russia and its invasion of Ukraine, a couple of geopolitical thoughts on the top of it. I'm not going to read these. But important is something that Biden said when this first started, and that he didn't say this directly, but he implied it, wars are inflationary. So what are the implications for this? It's an acceleration of the deflationary environment we've been to the last 40 years, away from that to a more inflationary environment. And that comes from globalization, which has definitely been part of that. That seems to have been reversing course, and we don't know to what degree that's going to take place. But also the commodity price inflation has been extraordinary this year. The EU still remains highly dependent upon Russian energy, and they're going to have to get off that. Get a near-term solution for that, which it looks like they're trying to figure out how to use a more global natural gas supply, and this also accelerate their transition to renewable energy. And then again, speaking of commodities, Russia and Ukraine supply a lot of the world's wheat and a lot of the world's fertilizer, and that has implications for a whole host of other commodities. Another big change is Germany has pledged to increase their defense spending to up to 2% of GDP. I think it's closer to 1 now. So this is most likely going to lead Germany from a fiscal surplus to a fiscal deficit, and that has implications not only for German interest rates, but global interest rates as well. And as far as the Russian economy, this is a quote from, I don't know if you saw it a week ago, the 60 Minutes piece on Russia's economy, but they face an absolutely economic abyss. And just as a reminder in history, at its peak, the Soviet Union was about 16% of the world's economy. When the Soviet Union broke up and became the Russian Federation, it slid down to maybe 6 to 8%. And if who knows how this war is going to end and how isolated Russia remains, but it's virtually going to be just a petrol state to a handful of large economies around the world. And that just makes it less relevant on the world stage. And then with all this inflationary buildup, it's going to lead to central banks increasing rates sooner, faster, and greater, which increases the probability of a hard landing. So let me hand it over to Dan, who's going to walk through a couple stress test analysis on this situation.
Thanks, Mike. As Mike mentioned, we have a couple of stress analyses that can help us frame the impact to your portfolio. Think of this as really a thought experiment. Of course, we know that the incursion into Ukraine is bad for markets. There's more uncertainty about supply chains, there are commodity shortages, which are certainly add to the inflationary pressures in the environment. There's some unknown impacts to corporate earnings, obviously the knock-on effects from there. So MSCI research developed these two scenarios that help us frame those impacts. Just taking you through them, there's sort of a soft landing scenario where the conflict de-escalates before the market prices in real structural changes. In this optimistic scenario, a ceasefire and a de-escalation of the conflict would stabilize energy prices around their pre-conflict levels. Apart from a small short-term impact, there are no persistent inflationary pressures. And then the hit to economic growth is relatively small. Central banks are sticking to their plans for tightening monetary policy, and you see the U.S. and German sovereign yield curves slightly flatten due to slower growth. You see global equities decline a bit, and then credit spreads would widen as the U.S. dollar strengthens relative to the euro. And then in the right column there, we're just kind of laying out the shocks that we would put in there for a dimmer scenario, where we see the prolonged conflict, which has longer-reaching market impacts. The idea here is that the sanctions impose a significant drag on growth and inflation. You see more extreme inflationary shocks. Nominal long-term rates go up as the long-term inflation expectations rise, but the real long-term rates drop and the economy slow down. You see higher energy prices, lower business and consumer confidence, which slow economic growth there. You see equities selling off more extremely, credit spreads rising, and then more significant gains of the U.S. dollar relative to the euro. And then given these assumptions, we can show you the results on the next slide. Thanks, Kate. Here we're showing the predicted returns for each of the scenarios for both the overall portfolio and then for certain strategies within your portfolio. Each scenario is represented by a different colored bar, resulting in the predicted change in value. And of course, that's plotted along the horizontal axis there. At the total portfolio level, you can see the results range from little more than 5% decline under the de-escalation scenario. It's a little more than 13% in the prolonged conflict scenario. You see international markets selling off more extremely than the U.S. as they're expected to feel the impact of the sanctions more deeply than our markets would. And finally, you can see there are more defensive strategies like TIPS and structured fixed income and even hedge funds mitigating those losses a bit. I'll leave you there. Happy to address, of course, any questions you may have now, or otherwise we can turn it back over to John Dorsa to move into executive session.
So Dan, I don't believe that there's any questions for the public session. So what I'd like to do is make a motion that we exit public session, enter the executive session to discuss matters pertaining to the specifics of the fund.
Second from the PBA.
Okay, so I would ask that any member of the public that is not affiliated with the. I'm sorry, a motion to enter into public session.
Exit executive, enter into public, all right?
Okay, so.
You have a second over here?
Second. Yeah. Second, Lutarco, LBA, all right?
So hold on, let me just make sure, do we have the, we're recording. Okay, excellent, being recorded.
All right, and away we go. All right, during the executive session, the trustees heard from their consultants, BAM, and several managers regarding infrastructure and private equity. Decisions were made. Those decisions will be made public at the appropriate time. And with that,
I'd like to make a motion to adjourn.
Second. Well, there you go.
all right.
Thank you.
Oh, thank you.
John?